Thank you, Brian. I should say I'm very honored to be invited to give the Phyllis Clarke Memorial Lecture and to be here in Toronto. I'd like to thank Ryerson and Brian and Cupid for making it possible. And what I'm going to speak on tonight is the global crisis, fiscal restraint, and public-private partnerships. And what I'm planning to do, if we have time, is the following. I'd like to start by explaining very briefly what PPPs are. I'd like to look then at the crisis and credit markets, then move on to the impact of that on PPPs. I'd like to look briefly at how the private sector responded to that impact, and then look at the state's reaction to what the private sector was demanding. Then I'd like to look at what these things are, what PPPs are, and how they are justified by the people who are promoting them. Look at the two arguments. One is a fiscal argument, one is a microeconomic argument. And then I'd like to conclude by looking at where we are now and where I think this whole business of PPPs is going. So that's the plan. Does that sound like it? There's two types of public-private sector partnerships, and one type is an infrastructure type, and the other type is a service type. On the infrastructure type, normally when the public sector builds hospitals, roads, bridges, it does everything except the financing. It designs, it does everything except the building of these things. So it does the design, it does the finance, it does the operations, it does the maintenance. And to finance them, it goes on to the bond market, borrows money for 20 years normally, and then finances, and that's the end of it. Repays that money over 20 years. In a PPP, the private sector is invited in to do more than just the building. The public sector doesn't build in this country. It's always the private sector. In a PPP, the private sector is called in to do the financing, to do the designing, possibly to do the maintenance and the operations, and sometimes even the ownership of the asset. And then the public sector then leases it back and pays the private sector for doing all these things. Is that fairly clear? Because that's basically it. So that's the first one. That's the infrastructure type. So, in Ontario, hospitals are now being built that way, with the private sector designing them, building them, financing them, looking after some of the operations, and then charging Ontario government, directly or indirectly, a fee for 30 or 40 years for doing that. And that fee covers the cost of the building, it covers the cost of the financing, and it covers the cost of operating the thing. So that's the way it works. On the service one, what happens is the government takes a chunk of its services and says, gives them to a private company and says, you run them. And whatever savings you can make, we'll share beyond a certain limit. Normally they give the private sector the first crack at the savings, and then you share 50-50, 60-40 after that. So Hamilton went with water and sewage treatment plant. The private sector was given $17.5 million out of an $18 million budget. The region kept $500,000, gave the private sector 17.5, and then they shared whatever they saved, and they saved all kinds of money. Usually it's by either laying people off or cutting their wages. There's not many ways of saving money on services. So these are the two types. And between 1985 and 2010, they started in the late 80s. There are about 3,000 of these things worldwide. 3,000 of them set up, costing about $1.4 trillion. So it's big business. Most of them were actually in the United Kingdom. In Canada, there were 168 for costing about $46 billion, which is fairly significant. Now, the crisis in the credit markets, there was an immediate effect in 2007, 2008 on PPPs. These PPPs, when they're financed, I'm talking mainly today about the first type, right? The infrastructure types, hospitals, roads, bridges, buildings, schools, jails, you name it, you can PPP anything. Universities, university libraries, they're all being PPP'd. Two types of financing. One is bond financing, for very large projects where you go into the bond market, you raise money that way, and then you pay the bondholders over so many years. Now, the way this worked, especially in Europe, was that these bonds would have been fairly lowly rated. Bonds for industry don't rate very highly, so they're expensive. So what the bondholders would do, what the issuers of the bond would do, is they go to insurance companies and they get them bumped up. They pay the insurance companies some money to cover risk, and they get them bumped up into a AAA bond rating like the federal government has got, like the World Bank has got. That's the best bond rating you can get. And then the prices come down somewhat. But you paid that fee to what were called the monoline insurers. Well, that was the first kind of financing. The second kind of financing was the bank financing. The bond financing was like 30 years, 25 to 30 years. The bank financing was for a lower period of time, about 15 to 20 years. And in bank financing, the rates were fluctuating all the time. So what you had to do then is you had to swap the things in order to get a constant flow of money going back to the banks to coincide with the constant flow of money which the government is paying these PPPs. Because normally they get paid so much a month or so much a year. It's a constant amount over 30, 40 years. So you had to convert the bank payments into very similar payments, and you paid for that. Okay? But again, it was a way of making the transactions feasible. Well, the bond market collapsed in the financial crisis, completely collapsed. And why did it collapse? Well, these monoline insurance companies, most of their business, or much of their business, had been in the subprime mortgage market in the US. So when the subprime market collapsed, as we all know it did, they were not in a position to handle the PPP money that they'd been handling, but the PPP money had always been profitable. They didn't lose money on PPPs. It was highly profitable, highly lucrative. But nevertheless, they didn't have the cash to lend money because of the collapse in the mortgage market. This was mainly in the United Kingdom where this happened. But we had just begun in Canada to have these monoline bonds. BC had this Golden Ears Bridge. That was monoline on bonds. With the kind of financial market collapse, the banks also had trouble, as we know. They withdrew because they had to look after, foreign banks had to go back and look after their own business at home. All the banks had to withdraw. The rates went up, the amount of money that was available went down. They cut the period of time over which they were lending. They changed the way they organized the deals. Usually in a PPP, it would be called what we call a syndicated lending deal, where banks would get organized in advance, right up front, with the technical proponents of the deals, Ellis Don or the big contractors or whoever it is who's doing that, and they would then arrange the bank financing through a syndicated loan business, right up front. That is supposed to have collapsed. I'll come back to that later. And in its place, you have what are called club deals, which are much smaller amounts of money by many banks, which come in at the end of the process, once you know who's going to get the business. The contracting business. Then you arrange the bank finance. So things have changed as a result of that. And they brought in what they call mini-perms. In other words, instead of financing for 20 years like they used to, they finance over 5 to 7 years, and it's got to roll over. And because you're rolling over, there are risks involved, that rates are going to change, and things are going to change. And so these mini-perms are much higher risk than it used to be. Well, in 2008, it all dried up. It all dried up. And there was a movement to a different kind of financing. It's called hybrid financing, where you do a long-term bond, but you precede it during the construction phase of these big projects, which take 2 to 3 years. You precede it with some bank financing, very short term. And also demands for the owners of these projects, because private business owns them now, right? They put equity in. They had been putting in 5 to 10% of the cost of the transactions in their own money. In 2008, that jumped up to 20% because the banks couldn't provide the rest. Tighter security was called for, and more provisions for default were put into place. The impact of this was, as I say, a complete shrinking of that PPP market. In the United Kingdom, which was the biggest market, 2008, there were 60 of these projects costing £8.4 billion. 60 of them. The next year there were 25 only, less than £2 billion. So it really shrank dramatically. In Canada, the Portman Bridge in BC, which had been planned as a PPP, was cancelled. They couldn't do it as a PPP, they couldn't get the money. The government had to finance it itself. And loans, it's difficult to get data on Canada. It's actually funny how difficult it is to get any data that makes any sense. But I did get some loan data. And the loans to PPPs, bank loans, fell from 11 in 2007 for 1.6 billion to 6 for 0.9 billion. So roughly half. There was a halving of the amount of money that came to PPPs. Well, how did the private sector respond to this? The private sector in this country is organized by the Canadian Council of Public-Private Partnerships. It's a lobby group. It's very, very well financed. It's financed by all the big banks. It's financed by all the big consultancy firms, all the big engineering firms, and by many levels of government. They brought all the business community members together and said, okay, what do you want? What do you want to do to make this thing work again? Because it's highly lucrative for the private sector. What you're doing in a PPP is you're handing over parts of the government which were previously done by the government much more cheaply. So the profits are huge. Well, they got together and they said a number of things. This is what they asked for. They asked for PPPs to be coordinated nationally so that finances could plan and get more in place, the costs would be smoothed out. They asked for all the fees. Whenever these things are put together, they're very expensive, and often the government funds even unsuccessful bidders to put these things together because the legal documentation is huge. Thousands of pages for a hospital, for instance. So they asked for a big increase in fees because everything got more expensive. So they wanted more fees from the state. They also wanted the separation of the technical side of these proposals from the finance. Get the technical in place, let's worry about the finance later, because trying to do it all at once is causing no progress at all on PPPs. So that's what they argued for. They wanted the public sector to pick up the extra cost of these mini-perms, these bank loans that are turning over and bringing higher risk. They wanted that risk to be covered by the public sector. And then they say that and what I'll do from time to time is quotes. I have this paper that's far too long, but I'll quote it for you if you don't mind. They argued that they would welcome any financial assistance that the public sector could give them, and then they conceded, in my opinion, somewhat disingenuously, consideration should be given to whether government funds could be better deployed elsewhere rather than invested into PPP transactions. We're supposed to take that seriously. The report is really all about the private sector being shored up by the public sector. So they'd welcome any financial assistance they could get. They'd like co-financing from government with the private sector, and they wouldn't mind some grants, but they were very careful about both of these. They don't want joint loans with the government or grants from government. They were careful, and it's a very odd thing that they would worry about this, but they were worried about bigger amounts of public money going into these projects up front, because the public always pays for them over 30 or 40 years, don't forget. They wanted money up front. They were worried that this might undermine the risk transfer, as they call it, to the private sector from the public sector. In other words, the arguments for these things might not hold up if the public sector was putting in too much money. They also, surprisingly, came out against the government giving credit guarantees because they argued there was no cost-benefit analysis that had been done on this, and it was very complex. It was a bit bizarre. They also decided that they didn't really want to go into funding competitions where the state organizes competition for finance, nor did they want to go into staple financing where these deals are put together by the state sector, and then they invite in the private sector. They thought this would interfere with their complex financial relationships that they've already established. Well, what can we say about this? On the stable financing, they're saying that this might bias the selection of sponsors, and as with funding competitions, where you compete for these things, undermine some existing credit relationships. So I would conclude on this that what the private sector is asking for is for the public sector to pick up the increased costs of doing PPP business that the credit crisis had induced, and to help better plan and coordinate PPP project pipeline, while stepping in to fill financing gaps that might still remain. Any direct financial participation should, however, be limited, temporary, and of a subordinate character. They wanted their loans to take first charge over the assets and everything else, which should not displace private equity or the preferred creditor status of private loans. And furthermore, there's a reluctance in the private sector to encourage more competitive funding arrangements, lest these undermine what I would call monopolistic relationships that the banks have among themselves. So that's where the private sector is coming from. How did the state react to these requests? Well, the state reacted internationally in the following ways. It varied a lot from place to place, but we know that there was a need to get out of the fiscal crisis, to get out of the crisis in 2008-2009. It was necessary for states to increase state spending. Monetary policy wasn't going anywhere, interest rates were just about zero in real terms. So you had to have a big expansion in state spending, that we know. But with PPPs, why would you use PPPs for, as a Keynesian way of restoring the economy? They take 2 to 3 years to plan. These things take ages to plan, right? That's not what you need when you're in the middle of an economic crisis. Well, what they did was they did set up new institutions for PPPs. They brought in new money for PPPs to support them. And they went out of their way to provide things which even the private sector wasn't asking for in some cases. So if you go to Europe, what the Europeans did is they set up a European PPP expertise center, and they almost doubled the amount of money that the European Investment Bank has available for PPPs. A huge amount of money. They put in an extra 106 billion euros into PPPs. In the United Kingdom, they set up a new treasury unit which had 2 billion pounds to put into PPPs. In the USA, they put in an extra $1.5 billion. And in Canada, we had 3 initiatives. We have PPP Canada Fund at $1.2 billion. And according to Flaherty, when this was set up, this was designed to help open the door to greater possibilities for P3s in Canada. That's what this is for, this fund. But there are 2 other funds. Sorry, there are 2 other funds. There's Building Canada Fund, $8 billion, but that's a 7-year project. But it was $8 billion. And then the Gateways and Border Crossings, another $2.1 billion. And both the Building Canada Fund and the Gateways and Crossing Fund have to go the PPP route. At least they have to consider the PPP route before they go in any other direction. So what the government was doing was promoting PPPs very, very strongly. What about the provinces? Well, in Ontario accepted some of the recommendations of this private sector group. They accepted 2-stage bidding, shorter tenor, more security, and they raised what are called substantial completion payments. These are grants. This is grant financing. So when a PPP builds a hospital, Ottawa or someplace, when they're more or less finished building it, the province comes in with a big chunk of cash. And that helps the private sector get over the hump. That has happened in a big way in Ontario. In BC, they were always doing that. They've done more of that. They considered co-financing. They considered funding competitions, which were not required by the private sector. But they also introduced what is called wide equity. And the wide equity model required the private partner to double their contributions from, as I said earlier, from 10% to 20%. And then the BC government puts in a big chunk of cash for substantial completion payments, grants. And so they basically pushed out private financing in at least 2 projects by doing that. In Alberta, which has always paid 50% substantial completion payments, they unbundled school projects. In other words, 30, 40 schools being built by one, they unbundled that. Now, whether that was a response to the crisis, to make it more affordable, if you like, for the credit markets, or whether it was because local contractors have been complaining that PPPs favor large contractors from out of province and usually from out of country, often from out of country, We don't know what the reasons are. In Quebec, they began to pay substantial contribution payments for the first time. So what do we conclude from that? Well, what I would conclude from that is that these developments in Canada were actually quite marginal. You know, in terms of the financial crisis, they were quite marginal. The federal government's initiatives have much less to do with responding to the financial crisis than the promotion of an ideological agenda designed to commodify state activities and to raise private sector profits from the provision of public infrastructure and services. The sums of money on offer are not large. These amounts are not large, and they're spread over quite a long time. This long delivery time of PPPs makes them clumsy and tardy as a vehicle for expansionary fiscal policy, and federal supported PPPs cannot be said to have played any role at all in the economic recovery of Canada. That'd be my conclusion based on it. And the provincial initiatives have been generally moderate and time limited, and they've often contradicted what the private sector was asking for, as I've said. But they haven't been huge in any major way. And the big concern of the private sector, as I've said, is that they were worried about losing the rationale for PPPs if the provinces got too involved. This was really what was happening. Okay. So why then are governments shoring up PPPs? Why are they pushing PPPs so much? What's the attraction? We know what the attraction is to the private sector. The private sector gets to make money out of things it never got to make money out of. It makes more money out of financing. It gets more money out of the operation and maintenance, the design, and probably makes more money out of project building. So we know why the private sector is interested. Why is the public sector interested? I think there are two main reasons. The first argument is a budgetary argument. Now, and it's an early argument that was very common in the 19th. If you read the book, a lot of what I'm saying is not in the book. But I mean, what the book does do is it traces the history of these things and traces how policy has changed. It gives a lot of case studies. In the early 90s, this fiscal argument was the main argument. Because if you get the private sector to build these things, they don't show up on the books of the public sector. So the argument is that public sector debt doesn't go up when you build these hospitals, when you build these schools, when you build these jails, when you build these roads. And therefore you can build more. Not on the books. This is the argument. Well, I think that argument is coming back now. It went out of favor to some degree. Now it's coming back. And I think if you do pick up the Socialist Register and read this piece by Brian and Greg, you'll see that we're in a stage now where we're moving from rescue strategies to exit strategies. That's what the governments are doing. And I think one of the exit strategies is going to be more reliance on the fiscal argument of PPPs, and I'll come back to that later. So, the arguments are there. We've got a big infrastructure gap, which is real. I traced that out in the book. And if you can keep the debts off the book and spend more money, why wouldn't you do it? That's the fiscal argument. This is an illusion. It's an illusion. Why is that? Well, two reasons. One is that over time, the accountants and auditors have got wise to this and are insisting that more of these things be put on the books. Because when you think about it, well, let me come back. The accounting principles that we're following now are being improved all the time. And there's a new set of accounting principles coming in called the International Financial Reporting Standards, IFRS. And under IFRS, it's tricky, but it looks like a lot more of these projects will have to be put on the books of the government, no matter what the government wants to do. That's one thing. The other thing is this, and this is my main argument, and we use this in the book. If you lease a car and you sign up, how many have ever done that? How many people have ever leased a car? Yeah, some of them, probably familiar. You lease a car, you sign up for 3 or 4 years. That is a contract, right? It's a contract for however many years you're leasing the car. It's just like debt. These things are contracts for 30, 40 years. They are payments which governments have to make. They're a liability. Liabilities are debts. So what the bond houses do is they add up all these liabilities, they translate them into today's money, they put them in the debt figure. When they're rating Ontario, they'll show up, not as debt, but as leases which are capitalized as debt. And that's really what they are, they're debts. So, you know, they might be off the books, doesn't matter. Ontarians are paying every dollar for these hospitals that has to be paid. They're paying them over 40 years, you can't get out of them, they're legal agreements, they are debt. So this argument that you get the debt off the books, in my opinion, is just bogus. It doesn't get you anything. Nevertheless, governments will do what they can to get them off the books because the public perception is that it's important that the government not take on more debt. So you've got a problem here between the auditors, reality, and then perception. The other thing about the fiscal argument is you have to ask, well, why is it that we're short of money to build infrastructure that all of us recognize that we need? All of us recognize we need hospitals. Why do we have problems? One is, most provinces brought in balanced budget legislation, which restricted themselves from borrowing money. Secondly, the last 10 years, provinces have been lowering taxes, especially on the rich. These are self-imposed restrictions. They can be reversed. Balanced budget legislation went out the window as soon as the crisis hit. So, you know, you can change these things. And ultimately, we're going to have to be prepared to pay taxes if we want, as we should, a fair level of public services. Anyway, so that's the fiscal argument, which in my opinion is bogus, but it's going to come back.